Hey everyone, welcome back to Corporate Decoder, the place where we take those twisty, turny corporate filings and try to make sense of them. Today, we're diving into Solaris Energy Infrastructure's latest annual report. Let's just say after this year, Solaris might need to change its name to Solaris, two different businesses going in slightly different directions, but you'll see what I mean in a few minutes. First up, the hook. Solaris just made a big bet on the future of power, diversifying their business in a major way. But is this a sun-powered success story, or are they getting burned? Alright, let's jump right in. Solaris, based in Houston, Texas, plays in both the oil and gas fields and the surprisingly hot market of mobile power generation. They deliver these services through two segments, Logistics Solutions and Power Solutions. And Power Solutions is the newbie, all thanks to a recent acquisition. That acquisition is Mobile Energy Rentals, or MER, and it's a pretty big deal for Solaris. MER provides mobile power generation stuff to energy, data centers, and other commercial and industrial clients. With this purchase, Solaris jumps headfirst into the power solutions game, but also they are still an oilfield service company, but that's how businesses change. They've got facilities spread around Texas for each of their main divisions. Now here's where things get interesting. It sounds like Power Solutions is mostly dependent on just one equipment supplier and one major data center customer. That's a risky position, especially with supply chains being what they are these days. The oil and gas side, or Logistics Solutions segment, on the other hand, deals with exploration and production companies through master service agreements. More customers there, but still dependent on the fluctuating needs of oil and gas companies. Solaris isn't the only player in these fields, of course. They are facing plenty of competition, be it from the existing power grid itself or from the numerous other companies offering energy services or supply chain and logistical solutions to their oil and gas clients. The good news is that the company says their business isn't heavily affected by seasonality, but like everyone else, they are subject to holidays and bad weather when there might be hiccups in their operations. Safety seems to be a big deal for Solaris, as it should be, especially with the physical demands of both the energy and logistics sectors. They seem to have safety and regulatory training in place for their staff, and it is definitely a good thing that they value their employees. Okay, now for the part where we talk about the real world, and the real world has regulations. Solaris is subject to a whole host of environmental regulations, including the Clean Air Act, the Clean Water Act, and a bunch of other federal and state laws. Failing to follow these rules could mean big costs and legal issues. They also face risks from climate change regulations and litigation, and because these may affect their clients as well, that could reduce the demand for what Solaris does. Switching gears, let's dive into the risk factors. Remember how I said two different directions? The first one is the volatility of oil and gas prices, which has direct consequences for the demand for Solaris's equipment. The second one is the risk that comes with jumping into a totally new line of business through the MER acquisition. New business means new risks, new competitors, and new regulations to follow. Another risk comes from relying on a small number of key suppliers, especially for the Power Solutions segment, which may face a scarcity of labor. Then we have the risk of technological advancements, something which can always upturn an existing business model. In this case, technology improvements to the fracking industry and solar power, I would guess, can affect their financials. And last but not least, they also state that they are facing cyber attacks, a very real and ongoing threat to basically every company these days. They also rely on being able to protect their technologies with patents. Now, before we get into the numbers, the report does mention a few things about the stock itself. Their stock price could be volatile, as stock prices are, plus future sales of their stock could drive the price down. And while they pay dividends to class of stockholders, they don't have to, it's not a guarantee. Okay, time for the numbers. The report shows that Solaris Logistics Solutions revenue decreased a little bit, but this was offset by a new stream of revenue coming from their brand new Power Solutions division. Also, to fund the MER acquisition, Solaris took on a significant amount of debt in the form of a senior secured term loan. That comes with a lot of covenants, restrictions, and you guessed it, more risk. The financing agreements also subject Solaris to some hoops they have to jump through financially, and if they are unable to meet these covenants, then more problems could arise. To further incentivize their partners, they pay what they call tax receivable agreement to realize certain tax benefits. But these payments may be accelerated and or significantly exceed the actual benefits, if any, that Solaris actually gets. Okay, that was a lot. So what's the story here? Solaris is trying to diversify into a high-growth area, but is this a risky move? Is it good for their stock? Well, on the one hand, the mobile power generation market is definitely expanding. Power demand is outstripping the grid capabilities for a few industries, including energy, data centers, cryptocurrency, and even AI. And a company that can deliver power solutions quickly and efficiently, like Solaris is trying to do, can definitely capture some value. On the other hand, they took on a lot of debt to make it happen, while also adding dependence on a single data center client and single equipment supplier. If those relationships sour, Solaris's returns in stock could plummet. But should all these assumptions pan out for them, they expect nearly $1 billion of capital expenditures and returns in the next 2 years. Meanwhile, the company's legacy oil and gas business is subject to commodity prices and more environmental regulations and legislation, especially that pertaining to climate change. So what do I think? It seems they made a calculated bet on a growing power market while hoping their history of excellence in oil and gas will keep that portion afloat. The company needs to be careful to not overextend itself. Their debt load gives them less flexibility to act in the market, but if they can execute effectively with their legacy clients and ramp up their power solutions arm effectively, it could all pay off. As the saying goes, high risk, high reward. Thanks for tuning in. If you enjoy videos like this, please give it a like, subscribe, and share this video with someone else. Until next time.